Good morning and welcome to today's business valuation webinar that will cover both startup and scale-up businesses as well as later stage valuations for established businesses. I'm Craig Sullivan, an audit partner at Bishop Fleming, and I'll be the chair for this session. I want to kick off by firstly thanking you all for attending today, and by hosting these webinars virtually, we're able to offer these sessions to a much wider audience. And really pleased to say that today we have over 400 in attendance, which is fantastic. It shows what a popular and interesting topic valuations is. The format for the webinar today is two presentations followed by some Q&A at the end. So please, as we go through the presentations, raise questions through the interactive Q&A chat option that you should see on your screen. And you can post your questions anonymously by ticking the relevant box or add your name if you're happy to do so. We'll be answering questions at the end of the webinar rather than after each presentation, and we'll try and answer as many questions as possible. However, if we don't have time to cover all of them, we'll share responses to any unanswered questions with you after the event. So the two presentations today will cover a number of important areas, including valuation methods, what are the key factors that impact on value, why evaluation is important when raising equity finance, and also when is the right time to exit as a shareholder. So first up, we'll hear from Martin Macy, who will pick up startup scale-up valuations. Martin is an equity fund manager at the FSE Group, and he's responsible for evaluating, executing and managing investments, of which he's completed several recent equity raises with some high growth businesses. Then we'll hear from Andy Hawkes, who is a director in the Bishop Fleming corporate finance team on valuing established businesses. And Andy's an experienced member of our team and specialises in share valuations, due diligence and advising clients on their acquisition and disposal strategies. So Martin, over to you.
Good morning, everyone. Great to be here today. So as Craig said, I'm here to talk to you for about 15 minutes on early stage business valuation. Okay, so firstly, Martin Macy, I'm an investment manager at FSE. FSE manages the fantastic £40 million Cornwall and Isles of Scilly investment fund. We can invest between £50,000 to £2 million per company. So just to give you a bit of background before I get into the main presentation, some of our portfolio companies are shown below. You can see it's a really interesting mixture of innovative businesses. The one that I've worked on most recently is Workfloat. That completed just last month. They completed an equity raise, and they're really, really busy. It's great to see, in fact, a real kind of reopening story. They're on an absolute tear post-investment, so that's great to see. So anyway, let's move on. What are the challenges of valuing an early stage business, a startup or a scale up, most likely for an equity raise? Well, typically the sort of profit projections and profit profile we see, it looks something like this chart here. So you can see this business, it's been making a loss, in the recent past. Maybe it's kind of break even, but compared to the forecast profit, there's really no comparison. So this is often what we see, and Andy will tell you when he talks about established business valuation. For established businesses, you normally look at this area here. That's probably your most important area. But of course, for an early stage business, you have to look at projections just as you look at historics. Often the projections are linked to disruptive technology. It's probably not completely proven. It might be very innovative, and this just adds to the uncertainty. So this is some of the issues we have. And I don't know if anyone recognises this particular set of financials, but it actually comes from none other than Tesla, so everyone's favourite US tech company. And yes, they are now one of the largest companies in the world. However, they do share a lot of similarities with startups, scale-ups, and any early stage business. When you think about their market, they're very early stage. It's disruptive. They don't make much profit at the moment, but they're forecast to make a huge profit. So quite an interesting example. They're valued at 1,000 times historic earnings. And by the way, I'm not saying that your business should be valued at 1,000 times historic earnings. It's just an interesting example. and others to think about. Just to give you some examples, I thought it's quite useful. We all saw Deliveroo quite recently, similar sort of story. Coinbase, there was a big IPO for a cryptocurrency business, and you know, they all have these challenges with valuation. So why is valuation so important? If you're, you know, as we said with Tesla, that they don't generate much cash at the moment, so they've recently had to raise $5 billion, providing their investors with 1% equity. But why is the valuation so important for that? Well, of course it's because equity capital raises typically work by issuing more shares at the same value as existing shares. So if you get your valuation right, then your existing shareholders, whilst their ownership percentage will reduce, and this, by the way, is what you call the cap table. So whenever you raise equity at your valuation, this is what you should prepare. So the ownership percentage of existing shareholders reduces post-investment, but their valuation does not. And that's why valuation is so important for startup and scale-up businesses. And you may think, well, hold on, don't I want to go for the highest valuation I can? And you know, our valuations are self-fulfilling prophecy. If I get this really high valuation, everything's going to come good, I'll grow into it. Well, you know, that has happened, but that you've got to be really careful. So if you have a valuation that's very high, probably the worst thing that's going to happen is you just don't raise any money. You know, if the investors are going to say, not going to do it. Also, to justify a very high valuation, you will need, as we said with Tesla, you need very high growth in your projections. So if you do manage to raise investment with very aggressive projections, but then you don't meet them and you might be missing them by 50% every month, that's not a good post-investment life, and it's very difficult to recover from that. So it's really important that you have a balanced set of projections. Also, with a low valuation, I mean, I won't go through all of these, but with a low valuation, your main issue there, I mean, you're going to raise the money most probably because investors will say, yeah, like that valuation. However, once you've raised the money, you're probably going to be beating your budget every month because you've probably got quite low projections, and your investors may say, well, hold on, we could sell our shares quite quickly because clearly they're worth more than we've paid. So potentially your sort of exit may happen too soon. So that's probably your risk there. So the key is you want a balanced valuation and projections for a harmonious post-investment business. So the good news is there are some techniques you can use to determine a valuation for an early stage business. The best way to start is to determine a range. So you want a minimum and you want a maximum. And if you think about it using this chart below, what we've got here is valuation on the vertical axis and the forecast annual return for investors on the horizontal axis. And this is termed internal rate of return, IRR. And of course, if the investors pay a very high valuation, they're going to have a low return. And if the valuation is lower, they're going to have a much higher return. So when you think about your minimum valuation, the best way to determine that is how much has been invested in the business to date. So that could be what you've invested personally. It could be your time. You know, what's your market rate salary? If you haven't taken a salary, then you should quantify that, and that's what's been invested. It could be grants, could be investment from other individuals. So that can determine a minimum value, and this is a real example that I worked on recently. So £300,000 had been invested in the business to date. To determine the sort of maximum valuation, the best way to think about this, so equity investors rarely invest where the forecast annual return is less than 30%. So if you look at your projections, look at say year 3 or beyond, apply what Andy's going to talk about, advanced business valuation techniques, And then if you discount back, so you get your valuation in the future, say year 3, 4, 5, and then you discount back at 30% per annum to give you a valuation of the business today that an investor would pay. And that would, I would say, that would typically be the maximum any equity investor is going to pay. So in this case, that was a valuation of 1.1 million for this example. Now, appreciate that's quite a large range, but it's better than no range at all. And on the next slide, we're going to talk about how you can narrow that range down. So to narrow down the valuation range of a business, I would say, so talking about your minimum valuation first, a good way to do this is calculate your run rate, profit and revenue. And so to do this, you want to look at the last 3 months for both and then multiply them by 4 to get an annualized figure. And potentially, if you've got, say, a new contract that you've won and you know that's going to happen, you could even adjust for that. And that's going to give you a kind of normalized run rate figure. And then you could apply the established business valuation techniques that Andy will talk about to give you a sort of, that's a pretty solid minimum valuation for your business. Also, you may wish to think about cap table milestones. So as we said with the cap table, equity ownership percentages are affected, so they will reduce as a result of the investment, even though the valuation of your shares won't if you get the valuation right. If you know that you don't want to go below, say, 50%, 5%, 75%, then you can work out the valuation which will ensure you stay above that level. It's not the be all and end all. Some people would say that could be the tail wagging the dog, but it's still a way to determine your theoretical minimum. Also, for the maximum, what it's all about, you want your investor to think that you're on path 1, getting you from A, where your business is today, to B, where you want it to be. If your investor thinks you're going to go off on path 2, that's when they're going to say, we don't need a 30% return, we need a 70% annual return, because there's a much higher risk that this business is going to, divert and go off piste, and we're not sure what's going to happen. So you want to say, have you done this before? Have you got someone on your team who has? How are you going to deliver this? And you've got to be talking about all of those things to get your investor, to be comfortable with 30% as opposed to 70% projected return. And when you've narrowed down your valuation range, don't be afraid to negotiate. So it often comes down to a negotiation exercise. So don't be afraid to do that. So some top tips: don't be blinded by valuation. There was an article, I don't know if anyone saw it, on BBC Business just this morning, in fact, and it said no money is better than the wrong money, and it was kind of talking about this. So it's possible for an investor to give you a set of terms that might have a great headline valuation, but there could be other terms in there that actually make that almost superfluous. So for example, the investor might say, I'm going to have a minimum return whatever happens. So the valuation, it might not even come into it. If you just can't agree a valuation, and sometimes this happens, if you can't agree a valuation, convertible loan notes can be a good middle ground. So convertible loan notes, we would still determine them to be an equity product, but they're quite clever, and they can convert into equity at a later date at a valuation which is dependent on certain factors. So sometimes that can work. Also, you do get growth loans, and we're able to offer that through the Cornwall Investment Fund. And sometimes they can be applicable, even if you can't agree a valuation for equity. Don't be too greedy, but don't undersell your business. Look to agree a sensible valuation which aligns the interests of all stakeholders. And of course, at the bottom here we have a unicorn. So a unicorn, I expect everyone knows, is a $1 billion business, a business worth $1 billion. That's often it's only been going for a short time, and we haven't had too many in the Southwest. But the good news is equity raising has been very positive of late. So Just to finish here, what this chart shows is the number of equity raises in Devon and Cornwall, which I thought is the key regions for a lot of the people joining. So you can see it's been quite consistent over the last 3 years, but Q1 2021, we've seen £100 million of equity raises, which has been much greater than anything in the last 3 years. And the number of equity raises, which is the line here, has also been strong, and it was also strong, not far off 20 in Q4 2020. So that's great. It's really encouraging. Long may it continue. So that concludes my presentation. I hope it's been useful. Please get in touch if you have any questions on valuation or equity raising. And on that note, I will hand over to Andy Hawkes at Bishop Fleming, who will talk to you about established business valuation.
Good morning, everybody, and it's great to be here talking to you this morning. As Craig said, we've got over 400 attendees at this webinar, which is absolutely fantastic. My name's Andy Hawkes. I'm a corporate finance director here at Bishop Fleming, and I've been advising clients on mergers and acquisitions with related business valuation issues for over 20 years. I know it doesn't show. I've been asked to talk about how we value businesses and look at some of the factors affecting value. I will also touch on when is the best time to sell. But before we look at valuation of established businesses, let me start by summarising what valuation methods are available to us, and there are a number. First up, we've got the multiple of earnings method, and this is based on a multiple of underlying profits, and it's probably the most applicable method for valuing well-established profitable businesses. We've then got the net assets method. This is basically the value included in the balance sheet of the company, and is the most appropriate method in 2 separate scenarios. So the business with significant fixed assets, for example, a care home business or a hotel business or an investment property business, where the value of the underlying asset is much larger than any value derived using an earnings multiple method, then net assets is probably the most appropriate way of valuing a business like that. The other scenario would be a business that is making losses, where clearly a multiple of profits doesn't derive any value, so then you would look at net assets in determining value. The third method is discounted cash flow. As Martin alluded to in his presentation, early stage businesses without a track record of profit, and it's all about future growth and the forecasts, then discounted cash flow is probably the most appropriate technique. And what we do there is we look at future cash flow projected generation, discounted back to present day values, and that's the value of our business. And finally, the fourth method is quite a technical one. This applies to the valuation of minority interests in a business where there is a history of regular dividends being paid. Now, I've only got 20 minutes, and I've been asked to talk about the valuation of established businesses. So let's focus on the first method, which is the multiple of earnings method. So you started a business and were able to secure growth capital from your new investors. Martin will hope it's his team that is investing in you, but obviously there are other investors out there in the market. You agree a 5-year strategy with your investors to grow the business, and as part of that plan, you will hope to exit the business and realise your investment at the end of the 5-year period. So 5 years fly by, you have a successful business and are talking with your investors about potential exit options. When out of the blue, you're approached by a competitor who makes you an offer. Now, the offer from your competitor looks something like this. We will offer you £5 million for your business. Okay, that's really interesting. £5 million looks like a great offer. But hold on a second, what's this? They're saying the offer is on a debt-free, cash-free basis. What does that mean? And they also go on to say the offer assumes a normalized level of working capital. Now, you've no idea what that means, so it's time to take advice. Now, the reason I've put this sentence up is that, well, two reasons. Corporate deals that we often see are usually structured in this way, and the way this offer is worded is quite closely aligned to the way we value trading businesses. So let's have a look at an equation, and who doesn't like to start with double maths on a Wednesday morning? Okay, equity value. So this is the price you are going to achieve for the sale of your shares, and that's made up of three components. The first component is earnings times an earnings multiple, and this is often referred to as enterprise value. Now, our potential buyer has offered us a headline price of £5 million, and that happens to be the enterprise value in this deal. Now, enterprise value represents the value of the business to all of its stakeholders. And to get from enterprise value to equity value, we need to add excess assets and deduct structural debt. Now, I'll come back to those two adjustments shortly, but let's have a look first at enterprise value. Two key questions. What earnings measure do we use in our assessment of enterprise value, and what multiple do we use? So let's deal with earnings first. Now, Ebitda is the most appropriate profit measure that we use in assessing value. Why is that? Because it's the profit measure most closely aligned to cash generation of the business. And here's a straightforward example, fairly straightforward example of how we determine earnings using Ebitda. So for those of you that don't know, Ebitda stands for earnings before interest, tax, depreciation, and amortization. So we take our profit after tax figure and start adjusting it for each of these items to get to Ebitda. So for each of the last 3 years in our business, we've got Ebitda at these levels. Now, as valuers, we are looking for underlying profit trends. So we need to adjust for any one-off costs or revenue lines that aren't representative of the underlying trade. In this case, 2020 profits were suppressed by one-off exceptional bad debt charge. So I've adjusted for it here to get to underlying adjusted Ebitda. We then weight year-on-year Ebitda to arrive at a single figure. This takes account of recent trading performance and gives more weight to the most recent profit figure. So we do the calculation and arrive at a weighted average Ebitda figure of £1 million, which is great because that's an easy number that I'll remember for the rest of this presentation. So that's the earnings part of our calculation. We've got an Ebitda of £1 million. Next up is the earnings multiple. How do we work out what that is? There are a number of sources of data available to us to determine what multiple we might use. So we could look at performance of companies on the public markets. We have published data for private company deal trends, and I've put up two examples here. The first one is PERDA, which is the price earnings ratio database, and the PCPI, which is the private company price index. Both of those publish quarterly data on earnings multiples being achieved in private sector transactions, and you can go and look them up and look at trends in what private companies are doing in terms of being bought and sold. You should talk to your corporate finance advisors who will have an in-depth knowledge of deals data. For example, at Bishop Fleming, we subscribe to the Bureau van Dijk database, which records data on all deals completed worldwide. So if we need data on multiples in a particular sector, that's our go-to source. You might also have your own knowledge of a deal price that a competitor achieved on a sale of their business. So we pull all of that information together and decide between us that the earnings multiple is somewhere between 5 and 6 for this business. You will never get a business valuer to provide you with a single price multiple. You will always get a range. And why is that? Well, at one end of the range, 5 represents the multiple that a buyer is prepared to pay. So our £1 million earnings at a 5 times multiple is the enterprise value, and that's the offer on the table from your competitor, £5 million. 6 represents the multiple at which a seller is prepared to sell. So based on our discussions, you would like to achieve an enterprise value of £6 million for the company. So assuming during pandemic that you can meet the buyer around the negotiating table, you might agree an enterprise value somewhere in the middle. So in this example, £5.5 million is the renegotiated enterprise value. Now we're cooking. We've already increased the price by £500,000. But wait a minute, what about these other elements? We're going to add excess assets to the figure. So excess assets are any assets in the balance sheet of the company that aren't used in normal day-to-day running of the business. So that could be in the form of an investment property or the chairman's Bentley. Those excess assets needed to be added on because those assets are not used to generate profits. In your company, there aren't any investment properties or Bentleys, but let's assume that you have £500,000 of cash in your balance sheet. So in addition to enterprise value, you remember the buyer said they would pay the £5 million on a cash-free basis. So they are prepared to give you the cash in the balance sheet as part of the deal. They have assumed in their offer that cash is an excess asset. I'll come back to this point in a minute. We also need to deduct structural debt, the debt-free element of our deal. Now there's a small matter here of the £2 million of bank funding sitting on your balance sheet, and that needs to be repaid from the £5 million offer. So now our equity value is at the £4 million level. But the buyer isn't quite finished with us yet. Remember that he said the offer assumed a normalised level of working capital. Part of your free cash figure is tied up in that working capital. The business needs some cash to operate. So we would need to leave behind a bit of cash from the deal. So not all of the £500,000 of cash is excess. Now, how do we work out what to leave behind? There are many ways of doing this, and really it's down to negotiation. But as an example, we could plot 12 months of working capital, the last 12 months, stock, debtors, creditors, in a graph. And the black dotted line on this graph is our actual working capital. And you'll see that it's fluctuating from month to month. The solid black line is the average working capital over that 12-month period. And if we look at December's position, we can see that actual working capital is £200,000 less than the 12-month average. So the buyer might expect you to fund that deficit and leave £200,000 behind. So in this example, £200,000 of cash is not an excess asset. So back to our valuation equation, we adjust our excess assets. Our cash goes from £500,000, we leave £200,000 behind, so we've got 300,000 of now excess assets, and the equity value for our company, i.e. the price we're going to get for our shares, comes out at £3.8 million. So that's a lot less than the £5 million headline grabbing offer that you received, but £3.8 million is the offer that's on the table. So beware, if there's one message I want you to take away with you today, make sure you take advice from experienced corporate finance advisors. The devil is in the detail. And more detail, you then spot some other wording in the offer letter. So it says our offer is subject to the completion of satisfactory legal, financial and commercial due diligence. So the buyer is looking for a reason to chip away at the price. And what are some of the factors that affect value? There are lots of different things that need thinking about, and here are just a few. Market or sector sentiment. Any transaction multiple will be a function of where the market is at a point in time, and there's not a lot you can do about this. It's just, you know, that's the market. If your business has a good track record of profits, then it's going to be more valuable. Businesses with fluctuating profits tend to be less so. What do your forecasts look like? A business growing and continuing to grow and with future growth potential will be more attractive to a buyer than one that is stagnating or in decline. What is the relationship like with your customers and suppliers? If your business is reliant on one or two significant customer accounts, for example, then that increases risk for the buyer and reduces value. Are your customer relationships contractual? Is there a level of repeat business? Those factors reduce risk and enhance value. In terms of suppliers, do you have a single source of supply, which is increased risk? And is there a contractual relationship for supply? So all of those things help to get the buyer more comfortable about the value they're prepared to pay. On the balance sheet, we've already talked about the impact that cash, debt and working capital have on value. So a stronger balance sheet improves the value of your business. And finally, I put up there management team. So this is a really important point when it comes to your exit. What impact does your departure have on ongoing operations? Is all the know-how with you, and can others take the business forward under new ownership? So all of these things and plenty of others will impact on the buyer's assessment of the earnings multiple they're prepared to pay for your business. So finally, when is the right time to sell? It should only be when you and your fellow shareholders are ready. On the previous slide, I mentioned some of the factors that affect value. And I would say another strong message here is don't take your business to market without having considered and mitigated those factors as far as you're able to. Think about some of the issues and put steps in place as part of your strategic plan to build the business, i.e. deal with those potential issues regularly as the business develops. And finally, I would say don't ignore them and don't leave it to the last minute to sort them out. Prepare your business for sale over an extended period. That's it from me. Craig, back to you.
Thank you both for the presentations. They're really interesting and generated quite a number of questions as well. So if I take these in turn and allocate them out. So the first one that's come through is, what impact has the pandemic had on business valuations? I think it's probably something that both of you could answer. So Martin, did you want to go first?
Yeah, sure. I mean, I found it fascinating. Of course, when the pandemic first struck in March last year, stock markets just went off an absolute cliff. You know, there was a huge dive, and you know, therefore valuations, you would say, went down very, very quickly. But then, of course, it didn't take long, and particularly in the US, with especially the tech companies. So the Nasdaq is the sort of technology market, a huge rebound, and then in fact, only a couple of months later, a lot of tech company valuations were above where they'd been pre-pandemic. Of course, a lot of them benefited from the kind of stay at home and that sort of thing. And what we've seen more recently is, you know, a lot of companies across the board have been catching up. So the reopening stories been coming out there. You know, as I said in my presentation, workflow, which is in the construction sector, is really, really on a tear. So yeah, I think there's no, right now, valuations overall, I would say there's no evidence that they're lower than they were pre-pandemic. I think if you're in the right sector, possibly they're higher, but it's an interesting crossover now because, you know, it's the kind of reopening story, and maybe those days of sort of tech valuations being sky high, maybe they're sort of leveling out a bit, is my feel. I don't know if Andy has any views on that.
Yep, I would certainly share some of your sentiments there, Martin. I mean, nobody really knows at the moment what impact the pandemic is going to have on business values. I would say we've seen no impact on multiples just yet. In fact, if anything, multiples have increased slightly for UK businesses over the last 18 months or so. We'll see what happens in the coming months and years, and I think we can expect multiples to reduce slightly as buyers are looking for bargains. Strong businesses will hopefully bounce back and be unaffected by what valuers will hopefully see as a short-term impact of the crisis in years to come. But what I would say is, if we're looking at business valuations at the moment, there is a more immediate impact on equity value because, quite simply, company balance sheets will have weakened over the last 18 months or so, supporting losses, draining cash reserves and taking out government support loans, and all of those factors will have affected equity values.
Thanks, Andy. The next question is one for you, Martin. It came up on one of your slides. So how does the quality of the management team affect the valuation?
Sure, thanks, Craig. So this is all about determining the risk in achieving the strategy. So I talked about the deliverability risk. And if you've got a management team, and you sometimes see this, you know, some management teams, they've done it before and they've delivered, and they've delivered a good result for the business and investors, and they're doing something quite similar. So you think, well, yeah, that's good. So that means as an investor, you can live with a much higher valuation compared to, you know, if the management team perhaps, you know, doesn't have the right skill set and they're going to have to learn a bit as they go along, and you think, yeah, that's going to be quite risky. So yeah, for sure, having a strong management team who you believe in, and I think also are really committed. You know, one thing I would say is it's easy when things are going well, but when things get tough, that's when the management team really comes into its own. So we look for a, you know, management team that's kind of there through hard times and good, and you know, we can build that into the valuation.
No, thank you. Thanks. Next question, Andy. It's a bit of a detailed question, but links in quite well with the example you gave. So when I'm valuing a business on a multiple earnings basis, I adjust the resulting enterprise value to derive an equity value by deducting debt, preference share interest, etc., and adding surplus non-trading assets, example, investment surplus cash. I've been asked to review an expert witness valuation where the expert adjusted the enterprise value by adding to the valuation executed on an earnings basis the net current trading assets. This would appear to be fundamentally wrong, as this is double counting value. The value of the net current trading assets are already accounted for in the earnings valuation. My thinking is the expert is confusing the concept of adjusting an agreed deal price for movements in the value of net current assets between deal being agreed and completion, i.e. on a real deal as opposed to a hypothetical valuation. Do you agree, Andy?
Right, my answer is a lot shorter than the question. Yes, I do agree. So you'll recall in my presentation I talked about excess assets. So we take the view that any assets and liabilities in the balance sheet that are a result of trading or a part of the makeup that delivers profit and value to this business should not be included in the valuation. The value of those assets and liabilities is already tied up in the earnings and the earnings multiple that we apply to get to enterprise value. So we would only look at anything that's excess. So the chairman's Bentley is the prime example of something we'd add on, but the Bentley is probably not something that the buyer is interested in. So we'd have to think about a mechanism to get that Bentley out of the company.
No, thank you, Andy. I think that question came in just before you did your example anyway, so I think your example was very comprehensive and covered off quite a number of the areas to consider. So next question, Martin. Does having EIS, SEIS approval impact valuations when raising equity?
Yes, so yeah, certainly can be a factor. So SEIS and EIS, for those who aren't aware, if you're an individual and you're investing in a business that has that kind of status, you get tax relief on the money you put in. So it effectively limits your, excuse me, your downside exposure, and also provides potential tax relief on your upside as well. So yes, if you're an investor, you can potentially afford to pay more if you have that in place. It's not always the case. So, I mean, for us as an institutional investor, it doesn't actually make any difference. But quite often we co-invest alongside individuals who, you know, where it does make a difference, and we would invest at the same valuation. So yeah, it's definitely a factor, and it's a good thing to have that status.
Okay, thanks, Martin. The next question I think would be interesting to get both your views on, both from an investor perspective and from a kind of DD advisory perspective. So when raising equity finance, is it better to propose a valuation to an investor or ask the investor to propose the valuation? Martin, did you want to kick off?
I guess it's it comes, as you say, this is an interesting one. If you're selling a business or if you're raising equity finance, it's a factor. I think for equity finance, I think it doesn't matter too much either way. But the important thing is that you have done your own homework, because you need to know, and you know, taking professional advice. Ideally, you need to know that the valuation is sensible for your business. So yeah, I think it's good to have a bit of dialogue, you know, certainly before any valuation is disclosed, and so you kind of set out your stall. But yeah, the key thing is you've done your homework.
Andy, did you want to add some your views to that?
I'd certainly agree with what Martin's saying there. I think it's a case of who's going to blink first. So as Martin says, absolutely make sure you go into any negotiating meetings knowing what your opening position is, but also what you're prepared to move to as part of negotiations. Set that level and make sure you don't go any further as you talk through the deal.
I think, as you highlighted in your presentation, Andy, it's being aware of some of those other factors and those other kind of narrative comments that the investors are looking to put in place as well, rather than just the top line valuation figure as well. I guess a number of people will be interested in the response to this one, which I think probably sits with you, Martin. Is Bitcoin overvalued? Please discuss.
Oh, yes. Yeah, interesting one. I mean, yeah, this is, I guess, as I was saying, with the kind of pandemic, Bitcoin has benefited hugely in terms of valuation and rocketed. It's an interesting thing to value. Of course, it doesn't generate any profit, Bitcoin. I mean, but neither does gold, for example. And gold is obviously very valuable. So it is very, very difficult to value. I'm not sure anyone knows how to value it. A lot of the commentary I've seen, I mean, but then you could say the same about gold, of course, which you know, people don't dispute has a real value. So I think it's too soon to say. Yeah, you know, it's clearly very volatile, and I think the big thing for me is, yes, there is a finite quantity of Bitcoin, but you can create more cryptocurrencies, right? So you know, surely that's different to gold, where, you know, I think gold you just can't make any more, can you? So that's my view.
Okay, thanks, Martin. Next question, Andy, if you don't mind picking up, what are your thoughts on employee ownership schemes?
Yeah, okay. They seem to be quite a hot topic at the moment, and quite a number of clients coming to me to talk about potentially transferring the ownership in their business to a group of employees. The only things I would say is, again, make sure you're taking advice, because there are some complex tax issues surrounding a scheme of this type. But I would also say be very wary of the structure and how you actually take it forward, because the administrative burden of dealing with an employee, a group of employees who are now shareholders in the business, you know, if you're handing out shares to 200 employees, that administratively becomes a complete nightmare. So I would just say tread very carefully. But yeah, it's an option.
Yeah, and it's weighing up those pros and cons in terms of that as an investment decision as well, isn't it? So, Martin, one for you. Any particular advice for pre-revenue raise?
Yes, that's right. They are tricky. So we, as a funder, we normally can't fund a business that is pre-revenue. We can fund a business that only has a very small amount of revenue, and the key is the revenue validates the product. So if there's no revenue, then obviously no product's been sold, and you know, that's the tricky thing. So yeah, it is difficult. I mean, I guess in honesty, a lot of pre-revenue businesses have to self-fund, you know, and there's nothing wrong with that. You know, sometimes it can be done, you know, it's not too difficult, but there are investors out there. Obviously, it's about finding them, and you need to convince them that you really have something. And if you don't have revenue, that's obviously harder. But maybe if you've got kind of awards, and you know, you're very active, I don't know, on social media, and there's clearly a lot of buzz and interest in what you're doing, then you know, hopefully that can bring investors on board.
Thank you. One for you, Andy. I think you mentioned this in answer to one of the earlier questions. What is the average of averages for the earnings multiple? Is 5.5 fairly middle of the road? Interested is looking to do a back of the napkin valuation rather than engaging in a lengthy exercise at this stage.
Yeah, okay, so I alluded to this in my presentation. So you'll never get a buyer and a seller to come to the negotiating table at a price they're both prepared to agree. There'll always be some negotiating. And I guess a multiple of 5.5 is absolutely down the middle. So there's an assumption there that both buyer and seller have knowledge of all the relevant facts that enable them to make a decision on whether they want to do a deal. So if they're all, you know, equally placed at the negotiating table, they should, by the law of averages, get to a 5.5 times multiple. That said, buyer might be prepared to pay slightly more because they see the opportunity of integrating that business with their existing operations and leveraging that additional value that the acquisition brings to them. So they might be prepared to pay more than 5.5. Equally, the seller might be desperate to sell, personal circumstances. They want to realize their investment and use the cash to do something else. So yeah, it's a difficult question to answer. On a level playing field, 5.5 is the right number to start with, but I would look at both ends of the buyer seller spectrum. So 5 to 6 is yeah, look at the range, But of course, to the person who asked the question, the multiple of 5 to 6 might not be the right number in your particular circumstances.
Okay, thanks, Andy. That sounds sensible. Andy, another one for you. How would a very high order bank be treated on completion? Is this classed as an excess asset?
Okay, I think that means high order book rather than bank. So again, this is about risk for the acquirer. If they're buying a business that has visibility and a pipeline of future sales, that's much less risky for them. So that would be reflected in the multiple, and they'd be prepared to pay a higher multiple for that business.
Thanks, Andy. I think another one for you, Andy, here. Again, linking back into your example, how are retained profits from previous years treated?
This is an important point, because if you've got a cash generative business, that business is going to accumulate over the years on the balance sheet. So there's an opportunity there for you to have lots of excess cash, which gets added onto the valuation. But your shareholders might also, over that period, require a dividend return. So that's, vote a dividend, and that's cash leaving the company. So cash goes back down again. So I think, again, this is part of your strategy. If over time, if you say, right, we're going to exit in 5 years' time, then you might initially start to pay dividends to give shareholders a return. But then as you approach a potential exit, you might want to start retaining that cash in your balance sheet, so that gets added on to the value of the deal, and that's actually much more tax efficient for you in terms of realizing that net cash position. So you'd pay tax at an entrepreneur's rate rather than tax at a dividend rate on extraction of that value.
Good tip, thank you, Andy. We've got some really good questions here, some really specific questions as well. So the next one, I think, again, coming to you, Andy, where there is a freehold property in the business and used for operations, would you value the freehold separately on an open market property valuation basis and then deduct a notional rent basis on that value to get to an adjusted Ebitda, then add back the freehold value to the adjusted Ebitda multiple to arrive at a total value? It's like an exam.
This is the tricky question right at the end, isn't it? I think this is all about consistency. So you might have the property sitting, if the property is sitting in a holding company and the trading business is being charged a commercial rent for the use of that property, then that rent charge is a deduction from Ebitda. So you've got the value of the trade with a rent deduction. So that's the earnings figure in assessing the value of the trade. But then you've also got the freehold property separately sitting in your holding company, which has separate commercial value. And I think if you apply that logic to the position where you've got a single company with a freehold property in it, then I think the notional rent point does apply in assessing the underlying trading performance of the business, but must remember to add on property value at the end to get to overall equity value. But it feels like, if the property is in the same entity as the trading business, then there might be a bit of tax planning and reorganization to think about to get the property outside of the trading business before you sell.
This one's come up for me actually in sort of previous roles. Craig, did you want me to just chip in quickly? Yeah. I was just going to say, I've seen this happen a few times. Yeah, I think the point is, so if you've got a business of a freehold property, it could do a sale and lease back, and potentially the value of the property may be much higher than the impact it has on the valuation of the business, due to its sort of impact on profit. So yeah, I think you'd certainly do it both ways. You'd look at look at the impact, and if there's a difference, then yeah, and potentially you could do a sale and lease back, or the buyer could do a sale and lease back, then yeah, you'd certainly want to move towards the higher valuation.
No, thank you, Martin. No, really good question, and yeah, thanks for those responses. I'm conscious of time, and we've got 4 questions left, so I want to try and get through them if we can. So the first one is, do you see valuations based on revenue multiples rather than based on earning multiples in the UK for tech companies? Andy, probably best pick that one up.
Yes, I mean, in my presentation, I talked about profit multiples as the basis for valuation, but there are a number of other methods. You could value the business on a gross profit basis. You can value the business on a revenue basis. So yeah, absolutely, revenue multiples are a potential mechanism to look at.
Okay.
Yeah,
Andy,
I'd chip in on that one, Craig, as well.
Yeah.
Yeah, this comes up a lot for us. So yeah, we often get businesses, that have revenue and maybe a loss making, and so yeah, for sure, there's a role for revenue multiples. Absolutely. My personal view is, any business, even if it's loss making, you should be able to reach some kind of adjusted profit. So often it's loss making because it's investing in its growth for the future. So if you add back what you're investing, you should still be at some sort of adjusted profit. So you've just got to tread carefully. There have been some horror stories out there, like one was Wirecard, and they did a lot of what you call round tripping, where they effectively sold something to someone and then just bought it back. So they had massive revenue and no profit, and people believed it. And of course, it was all just a fabrication. So yes, revenue multiples work for sure, but don't forget about profit.
Good point. Thanks, Martin. Andy, you're mentioned by name here. Andy, would you advise your clients to get their legal team on board to work out with you to get the heads of term in shape to shake out the valuation issues from the detail?
Yes, absolutely. I mean, too many times I see clients coming to ask for advice when deal negotiations are already significantly advanced. So I would say get your corporate finance advisor and your legal team on board at an early stage, as soon as that offer comes in, or even before that, when you start to think about selling, start to have those conversations early, because we quite like a no surprises approach as we get into deal negotiations.
Thanks, Andy. And I'll pick one last question before we wrap up, and as I said, we will share any answers to any unanswered questions as we go through. So in an MBO situation, at what point should advisors be engaged by the management team? It's been suggested that an offer must be made to the existing owners before advisors can be engaged. Martin, did you want to pick that up?
Yeah, sure. So the engaged by the management team. I think in an MBO situation, I think you should engage your advisors early on. I mean, normally you can, you obviously don't want to be sort of paying huge fees to begin with, but normally you can agree it so the fees are sort of, potentially contingent, or at least paid as the deal progresses. So I think you should be engaging advisors before you make any sort of offer in an MBO situation. Would you agree, Andy?
Yep, absolutely. Engage your advisors early, as early as you possibly can.
Brilliant. Well, conscious of time, thank you all for attending today, and a big thank you to our speakers, Martin and Andy, for a really insightful session that's generated lots of questions and highlighted some really important messages on how businesses can be valued. For further information and access to other insights, which is constantly being updated all the time, please refer to the FSC Group website and also the Bishop Fleming website, where the Corporate Finance Knowledge Hub can be found. And we'll be sharing links following this event. We'll also be sharing slides, and there will also be a recording available which will be shared on our Knowledge Hub. So if there's anything you want to come back to, you can revisit it there. Thanks very much again for attending, and hope you enjoy the rest of the day.